Picture the scene. It's December 2024, and Jeff Currie, the man who spent 2 decades as Goldman Sachs head commodity strategist before moving to Carlyle Group, stands before a room of institutional investors and delivers a forecast that sounds like a promise. "We are entering," he says, "a decade-long commodity supercycle, the revenge of the old economy." The room erupts, not in concern, in excitement. Because to the people in that room, rising prices for copper, oil, wheat, and lithium don't signal danger. They signal alpha, diversification, inflation protection, a rotation into real assets after years of chasing tech stocks. But here's the contradiction that should make your skin crawl. The same phenomenon that Wall Street celebrates as a generational investment opportunity is, for most of the world, a slow-motion catastrophe. When commodities stay expensive not for months, but for years, it doesn't create wealth. It redistributes it, upward, violently. So, the question isn't whether Currie is right about the supercycle. The question is, what happens to societies when energy, food, and raw materials become permanently expensive, and the people profiting from that pain are the same ones calling it inevitable? Let's be precise about what's at stake. As of early 2025, global exchange inventories for copper and aluminum represent 3 to 5 days of global consumption. Not months, days. The International Energy Agency reports that to meet 2030 net zero goals, copper supply must increase by an additional 10 million tons, and currently, only a fraction of that is in the committed project pipeline. Meanwhile, the FAO Food Price Index remains 15 to 20% higher than 2019 averages, not because of a temporary supply shock, but because the cost of hydrocarbon-based fertilizers derived from natural gas has structurally risen, and climate-induced crop failures in major exporting regions have become routine, not exceptional. This isn't abstract. In Egypt, bread subsidies consume nearly 10% of the national budget. In Sri Lanka, fuel price increases triggered the collapse of a government. In Pakistan, flour shortages sparked riots. These aren't outliers, they're previews. And here's the part that should terrify anyone paying attention. The commodity supercycle thesis doesn't predict these prices will fall. It predicts they'll stay high through the early 2030s. That's not a forecast, that's a fuse. To understand how we arrived here, you need to picture 3 distinct moments that set the stage. The first, 2014. Oil collapses from over $100 a barrel to below $50. The fracking boom has flooded the market, OPEC is engaged in a price war with US shale, and the message from financial markets is clear. Don't invest in extraction. Capital expenditure in oil and gas plummets by over 40% between 2014 and 2021. Money flows toward asset-light technology, cloud computing, apps, algorithms. The old economy of drilling rigs and copper mines becomes unfashionable. ESG mandates accelerate the shift. Institutional investors derate mining stocks. The era of capital starvation begins. The second, 2022. Russia invades Ukraine. Europe, which had spent 2 decades building its energy policy around cheap Russian natural gas, watches in real time as that assumption disintegrates. Gas prices spike. Wheat exports from the Black Sea breadbasket collapse. Suddenly, the fragility of just-in-time globalization is visible to everyone. But the damage was done long before the tanks rolled. The underinvestment of the 2010s means there's no reserve capacity to call upon. The world has been running on fumes, and now the fumes are gone. The third, late 2024, Bloomberg NEF releases its transition metals outlook. The numbers are staggering. The energy transition requires $215 trillion in investment by 2050. A significant portion must be spent upfront on lithium, cobalt, nickel, and rare earths. But here's the problem. It takes 10 to 15 years to bring a new copper mine online. Even if capital returns today, supply cannot respond immediately. These 3 moments reveal a pattern. a decade of ignoring physical reality, followed by a reckoning that cannot be solved with spreadsheets or central bank policy. Let's explain how this actually works beneath the headlines. The commodity supercycle thesis rests on three structural forces converging simultaneously. First, supply inelasticity. Extraction is asset-heavy. A copper mine in Chile or a lithium brine operation in Argentina requires billions in upfront capital, environmental permits that take years to secure, and geopolitical stability in regions that often lack it. When prices rise, supply cannot respond quickly. This is the opposite of software, where scaling up means copying code. In the physical world, scaling up means dynamiting mountains and building infrastructure in remote deserts. Second, demand surge from decarbonization. An electric vehicle uses 4 times more copper than a gasoline car. A single offshore wind turbine requires 15 tons of copper. Solar panels need aluminium, silver, and increasingly rare earths for inverters. The global push to decarbonize isn't a choice. It's policy mandate backed by trillions in subsidies. That demand is structural, not cyclical. It doesn't disappear when the economy slows. Third, geopolitical fragmentation. For 20 years, globalization acted as a deflationary force. Commodities were sourced from wherever was cheapest: Chinese rare earths, Russian gas, Saudi oil. But the shift from global efficiency to friendshoring means supply chains are being rebuilt in higher-cost jurisdictions. The United States wants lithium from Australia, not China. Europe wants gas from Norway, not Russia. This deglobalization removes the price discipline that kept commodities cheap for 2 decades. Now layer on top of this a fourth force: monetary debasement. With global debt-to-GDP ratios exceeding 330%, institutional investors are rotating back into hard assets as a hedge against currency devaluation. When sovereign debt becomes unsustainable, gold, oil, and copper don't default. This financial demand further bids up spot prices, disconnecting them from immediate physical supply and demand. Here's the mechanism in action. A car manufacturer in Germany needs copper for wiring. The spot price has doubled, but they can't wait. Production lines are scheduled, so they pay the higher price and pass it to consumers. Meanwhile, a pension fund in Toronto allocates 5% of its portfolio to a commodity index, not because they need copper, but because they need inflation protection. Both forces, industrial and financial, push prices higher, but only one of them actually uses the commodity. This is how you get a supercycle: tight supply, structural demand, geopolitical premiums, and financial speculation, all moving in the same direction for years. Here's what Jeff Currie and the institutional investors celebrating this supercycle don't say out loud. Sustained high commodity prices are a regressive tax on the global poor and the middle class. Energy, food, and raw materials are inelastic costs. You can't negotiate with hunger. You can't opt out of heating your home in winter. When these prices stay elevated for years, they don't just erode discretionary spending. They erode the legitimacy of political systems that can no longer deliver basic stability. Look at the incentives. Commodity producers, OPEC+, lithium miners, copper majors, maximize rent and state revenue. They win. Institutional investors seeking alpha and inflation protection rotate into commodity indices and real assets. They win. But lower and middle-income households, whose budgets are dominated by inelastic costs, see their purchasing power collapse. Governments in resource-poor nations face an impossible choice: massive subsidies that lead to fiscal ruin, or austerity that leads to protests. This isn't speculation. History is clear. The 1970s commodity boom, driven by oil embargoes and loose monetary policy, didn't end with adjustment. It ended with stagflation, political upheaval, and a decade of credibility destruction for central banks. The Arab Spring in 2011 was triggered not by Twitter, but by wheat price spikes that made bread unaffordable. The revenge of the old economy that Currie celebrates is, For much of the world, a revenge against the poor. And here's the cruel irony embedded in the green transition narrative. The effort to save the climate requires more mining, which is carbon-intensive and ecologically destructive. Western nations want the minerals for their electric vehicles and solar panels, but they won't permit the mines on their own soil. So the environmental cost is exported to Chile, Indonesia, and the Democratic Republic of Congo, countries with weaker labor and environmental protections. This is the green paradox, climate policy that entrenches resource extraction in the places least equipped to regulate it. The Supercycle thesis treats this as a market opportunity. I see it as a political crisis in slow motion. When inflation becomes permanent for households, even as it's declared temporary for markets, the gap between financial optimism and lived reality becomes unbridgeable. Central banks focus on core inflation, which excludes food and energy. But citizens don't live in core budgets. They live in the real economy, where gas, groceries, and heating costs are climbing, and no amount of reassurance from Jerome Powell or Christine Lagarde changes that. This isn't a bull market story. It's a pressure test for political systems already losing credibility. And the people celebrating the returns are the same ones insulated from the consequences. Let's be fair. There are serious, well-informed people who think the supercycle thesis is overblown or even wrong. The technology as deflation argument. ARK Invest and others contend that AI-driven efficiencies in extraction, combined with the rapid decline in battery costs following Wright's Law, will eventually render commodity scarcity obsolete. Technology, they argue, always finds a way to do more with less. Copper demand might be high, but if AI optimizes mining operations and new drilling techniques unlock previously inaccessible deposits, supply can catch up faster than the pessimists predict. This argument is compelling. Technology has historically defied Malthusian scarcity predictions. The green revolution in agriculture, fracking in oil and gas, and the substitution of fiber optics for copper and telecommunications all support this view. But here's the problem: the timeline. Even if AI optimizes extraction, it doesn't eliminate the 10 to 15-year lead time to bring a new mine online. Even if battery costs fall, it doesn't change the fact that today's supply deficit is real and worsening. The optimists are betting on a future solution to a present crisis. That's not a forecast, it's a hope. The China's slowdown argument. As China's property sector, the world's largest consumer of iron ore and copper, structurally declines due to demographics and debt, a massive hole is left in global demand. The green transition, critics argue, may not fill that gap. If China's urbanization is over and Western demand for electric vehicles stalls, commodity prices could collapse, not soar. This is a legitimate concern. China accounted for over 50% of global copper demand during the 2002-2011 supercycle. If that engine sputters, the demand side of the equation weakens dramatically. But the counter is this: decarbonization is policy-driven, not consumer-driven. Even if EV adoption slows in the US or Europe, government mandates and subsidies will continue to push demand. The Inflation Reduction Act, the European Green Deal, and China's own transition away from coal all create structural demand that doesn't disappear when consumer sentiment sours. The substitution effect argument. High prices trigger innovation. If cobalt becomes too expensive, engineers develop cobalt-free batteries like lithium iron phosphate, LFP. If copper prices soar, industries find ways to use aluminum or other substitutes. This substitution eventually crashes the price of the original commodity. The IEA Minerals Report acknowledges this dynamic. Substitution is real, but substitution takes time, and in the interim, prices stay high. Moreover, some minerals have no easy substitutes. You can't build a wind turbine without rare earths for the magnets. You can't electrify the grid without copper for transmission lines. Substitution works at the margins, but it doesn't eliminate the core bottleneck. I'll grant the optimists this. If AI accelerates discovery, if China's demand collapse is steeper than expected, and if substitution happens faster than precedent suggests, the supercycle thesis could fail. But betting against scarcity when inventories are at historic lows, capital investment has been suppressed for a decade, and geopolitical fragmentation is rising. That's not analysis. That's wishful thinking. Let's name names. Let's be specific about who wins, who loses, and who gets distracted. Commodity producers. Saudi Aramco, Exxon, Chevron, BHP, Rio Tinto, Glencore. These companies capture windfall profits as prices rise. OPEC Plus gains geopolitical leverage. When oil is $90 a barrel, Russia funds its war machine, and Saudi Arabia funds Vision 2030. Lithium producers in Chile and Australia negotiate terms with Western governments desperate for supply security. These are the landlords of the physical world, and rent is due. Institutional investors, pension funds, sovereign wealth funds, and hedge funds with commodity allocations see portfolio returns surge. The people managing trillions in assets get their performance bonuses, while retirees see grocery bills climb. The asymmetry is obscene. Lower and middle-income households in every country. In the United States, a family spending $400 a month on groceries in 2019 now spends $480. In Egypt, bread subsidies consume nearly 10% of the national budget, and the government is running out of foreign reserves. In Pakistan, wheat flour shortages sparked riots in Punjab. These aren't abstractions. They're real families making impossible choices between heating and eating. Governments in resource-poor nations, countries that import energy and food, face fiscal catastrophe. They must choose between subsidies that bankrupt the treasury or austerity that triggers protests. Sri Lanka already fell. Pakistan teeters. Egypt negotiates bailouts. The commodity supercycle doesn't just redistribute wealth, it destabilizes sovereignty. Tech and EV manufacturers, Tesla, Rivian, Volkswagen, Ford, all face margin compression as input costs soar. Either they absorb the costs and watch profits evaporate, or they pass them to consumers and watch demand collapse. The green transition becomes unaffordable precisely when it's supposed to accelerate. Canadian farmers in Saskatchewan and Manitoba who depend on canola exports watch as fertilizer costs, tied to natural gas prices, make their operations unprofitable. Truckers in Poland see diesel prices rise and wages stagnate. Factory workers in Vietnam assembling electronics face layoffs as manufacturers relocate to avoid tariffs and commodity premiums. This is the macroeconomic reality of a supercycle. It's not prosperity, it's extraction. Wealth flows from the many to the few, from consumers to producers, from the powerless to the powerful. If you want to understand where this leads, look at the 1970s. The decade began with the Nixon shock, the end of the gold standard, and proceeded through two oil embargoes in 1973 and 1979. Commodity prices surged. Inflation became sticky. Central banks, led by the Federal Reserve, initially treated it as temporary. They were wrong. By the end of the decade, inflation had destroyed the credibility of monetary policy, eroded middle-class savings, and triggered political upheaval across the developed world. The parallel is exact. Both eras featured a decade of loose monetary policy, followed by supply shocks, followed by inflation that resisted intervention for years. In the 1970s, central banks eventually crushed inflation by inducing a recession so severe that unemployment hit double digits. The Volcker shock of 1980 to 1982 worked, but the human cost was staggering. The difference today is that the supply shocks aren't geopolitical accidents, they're structural. The underinvestment in extraction, the shift to friendshoring, the raw material demands of decarbonization, these aren't temporary disruptions, they're the new baseline. And here's the uncomfortable truth. The 1970s ended with Thatcher and Reagan dismantling the post-war social contract. When inflation erodes living standards for long enough, voters don't demand reform, they demand retribution. The political systems that emerge from prolonged commodity booms aren't stable. They're vengeful. Let's return to that room in December 2024. Jeff Currie announces the commodity supercycle, and the investors erupt in applause. But step outside that room. Walk into a grocery store in Cleveland, a bread line in Cairo, a gas station in Karachi. Because what Wall Street celebrates as the revenge of the old economy is for most people just revenge. When energy, food, and raw materials stay expensive for years, societies don't adjust, they fracture. The political systems that delivered stability for decades lose legitimacy when they can no longer deliver affordable bread. The supercycle thesis is correct. Commodities will likely stay elevated through the early 2030s. But the language matters. Calling it a bull market obscures what it actually is, a decade-long wealth transfer from households to producers, from the poor to the powerful, enforced not by policy, but by scarcity. And the people who profit from that transfer, the commodity traders, the institutional investors, the mining executives, will never frame it that way. They'll call it a cycle, an opportunity, the inevitable result of market forces. But here's the question that should linger. When inflation becomes permanent for the people who can least afford it, and temporary for the markets that benefit from it, how long before the gap between financial optimism and lived reality becomes unsustainable? Jeff Currie is right about the supercycle. He's just wrong about what it means.